very good morning to all the students. We shall now discuss aggregation of income, block 1 of income tax. Clubbing of income is the topic title, which contains provisions relating to totaling of income from section 60 to 64 of the Act. So, the topic covers transfer of income where there is no transfer of assets, revocable transfer of assets, that is where the SSE can revoke back the asset after he has transferred, commission, salary, etc. of spouse under section 64(1), subclause 2, income of spouse from the assets transferred under section 61(1), clause 4, assets transferred to son's wife without adequate consideration under section 64(1), clause 6, assets transferred to association of persons, that is cooperative societies or trusts, etc. under section 64(1), clause 7 of the Act, income to a person from the assets transferred under section 64(1), clause 8. It also covers income of minor child under section 64(1)(a) of the Act, transfer of individual's property to HUF, that is Hindu undivided family, under section 64(2). Towards the end, we also shall discuss few illustrations. Now, let us understand the introduction, a brief introduction of and the meaning of clubbing of income. Normally, a person is liable to pay tax only in respect of income belonging to him and not on income belonging to others. That is a well known concept. But there are many occasions where one may require to club income, that is total income of someone else, with own income. So, the other's income is added to the personal income of the SSE. That is when transfer of any assets, income to another person as a means of tax planning or also evasion in some cases to avoid the income getting taxed. So, this is a very common practice where people avoid tax and transfer their income to others. Such transfers result in attraction of clubbing provisions under the Indian income tax laws. Under Income Tax Act 1961, there are certain provisions as per which an income though legally belonging to one person is included in the total income of the other person, that is the transferor and the transferee. So, we shall now see provision one after the other. The first one, for a better understanding, we shall divide it into the concept of the section number, specified person, that is who is eligible or who comes under this provision, the situation that arises and whose income shall it be clubbed to. So, we have two parties here, transfer and the transferor in the transfer. So, section 60 of the Act. So, the specified person can be anyone. So, it is not supposed to be only for a particular individual or an AOP or a HUF. There are 7 different types of person. Any person comes under this provision. The situation here is transferring income without transferring asset, either by way of an agreement or any other way. So, that is asset is kept with the transferor, only the income is transferred. So, here what is the provision that is applied? So, income that from such an asset shall not be the income of the transferee, though he is received the income. Legally he might be the one who receives the income, but shall be clubbed in the hands of the transferor and shall be included in the gross total income. That is very simple. The whole aspect is the transferor with an intention to evade tax must have transferred the income though the asset belongs to him. So, a quick example, Mr. Raman owns a house property, so it is belonging to him, from which he earns a rental income amounting to 20,000. Now, suppose he transfers such rental income to his wife. The property belongs to him, but the income is shown as if it belongs to his wife, either by directing the tenant to pay the rent directly to her or by otherwise. So, after he receives, he might have given it to her and tries to show it as the income of his wife. In this case, although rent will be received by his wife, yet it shall be included in the income of Raman, the transferor of income. So, this is section 1, which says asset is not transferred, but the income is transferred. So, this very clearly shows that he has intentions to evade tax. Coming to the second provision, revocable transfer of asset. The very word revocable, the meaning of revocable is where at any time in the future the transferor can ask the asset back to him. From though he has transferred the asset, he has intentions to recover the asset back. So, revocable transfer of asset, commission, salary, etc. of spouse under section 61. So, section 61, the specified person, it can be any person. So, transferring asset on the condition that it can be revoked. Revoked means he can ask back the asset at any time. Transfer includes settlement, trust, covenant, that is a commercial loan, agreement or arrangement. A transfer shall be deemed to be revocable. So, what does it mean by saying revocable? It says if it contains any provision, that is an agreement between the parties, any provision for the retransfer directly or indirectly of the whole or any part of the income or assets to the transferor. So, the transferor, he transfers it to the transferee with an agreement that any time in the future he shall recover the asset back or gets it retransferred. So, such a transfer is called revocable transfer. It is in any way gives the transferor a right to reassume power. So, in the very first place, the transferor is having the power with him to recover the asset at any future date, power directly or indirectly over the whole or part of the income or assets. So, the whole idea is he transfers the asset only for a temporary purpose to evade tax, so that he can recover the asset at a later date. Now, how does this whole provision work? So, income to be clubbed, any income from such asset will be clubbed in the hands of the transferor. Exceptions, there are few exceptions here under section 62(1). It says if the transfer is in the way of trust, which is not revocable during the lifetime of the beneficiary. So, there are few people who would wish to transfer their asset to any trust for the benefit of the beneficiaries. So, there is an arrangement that in any time in the future the trust will not be revoked. So, obviously, in the very first place it is not a revocable transfer. So, this is an exception. If transfer is otherwise than by way of trust and not revocable during the lifetime of the transferee. So, it is not revocable in the first place, and he has made an arrangement that during his entire lifetime the transferor shall not revoke the trust. The transfer is made before the first day of April 1961, that is the date when the Income Tax Act has come into being. So, this provision is also added as an exception which is not revocable for a period exceeding 6 years. Now, the quick example here, Mr. X transfers house property to Mr. Y, which shall not be revoked during the lifetime of Mr. Y. So, Mr. Y is the transferee, Mr. X is the transferor. So, there is an arrangement that Mr. X will not ask for the retransfer of the asset or income at any period of time during the lifetime of Mr. Y. Thus, any income from the transferred HP shall be treated as income of Mr. Y, transferee alone. So, in this case there is no revocable agreement. So, that is the reason why the income so derived from the house property transferred to the transferor, the transferee, hence the income belongs to Mr. Y alone. Coming to the third section, commission, salary, etc. of spouse under section 64(1)(2). So, this is a very unique case, that is where the section is regarding the relation between spouse. So, one spouse can be both wife or husband. So, one of the spouse has a substantial interest in an organization or a company. So, taking that as an advantage, the other spouse, though he has no qualification or no specific knowledge skills, he joins the company and receives some income. In such a situation, this section evokes the provision. So, section 64(1)(2). So, this is specified person here, that is with regards to the spouse. Spouse includes both wife and husband. It can be interchangeably used. Spouse is a term which can be used for both husband and wife. If spouse receives any remuneration irrespective of its nomenclature, such as salary, commission, fees or any other form and by any mode, cash or in kind, from any concern in which SSC has more than 20% substantial interest. The meaning of substantial interest is where an SSC, so the SSC can be both a male or a female. So, an SSC holds substantial interest, that means he has got voting rights, he holds capital in a company, and then since the SSC has substantial interest, the other spouse takes advantage or both of them take advantage, and the other spouse join the organization without any knowledge, skill sets, or without any specific employment as such. He is just joining because he has got the influential power. Okay, so what happens here? Income to be clubbed. Income shall be clubbed in the hands of the taxpayer or spouse whose income is greater before clubbing. Exception to clubbing: clubbing is not attracted if spouse possesses technical or professional skills. So, the whole element here to be identified is whether the spouse is appointed in the company due to his specific professional qualification or skills, or only because the other spouse holds substantial interest. So, he possesses, in case the spouse possesses technical or professional qualification in relation to any income arising to the spouse, and such income is solely attributable to the application of his or her technical or professional knowledge and experience. In such a case, this will not be clubbed. That is, the income earned by the spouse, though he is not having substantial interest, he is appointed only because of his qualification, the other spouse holds substantial interest, then their incomes will not be clubbed. A quick example: income of Mr. D and Mrs. D for the relevant PY, it could be any PY or the previous year, is given below here. Mr. D receives salary of 2,15,000 from a company where Mrs. D holds 22% equity share capital. So, in the above clause it was mentioned that he should have substantial interest more than 20%. Mrs. D earns 10,000 as income from other sources. She must be having dividend income or income from house property or any other income. So, Mrs. D holds substantial interest in the company and Mr. D joins the company. He has no qualification nor experience to be employed in the company, but then he joins all because his spouse, that is Mrs. D, has substantial interest in the company. And here the clause to be looked at is whether she holds more than 20% equity shares. Yes, in this case she holds more than 20% equity shares. So, now it is very clear that Mr. D, though he is an employee, has no qualification. Mrs. D holds 22% equity shares in the business. So, that is the reason why Mr. D had joined the business or the company as an employee and he received salary. So, to conclude, the salary received by Mr. D shall be added in the income of Mrs. D as she holds more than 20% shares and Mr. D does not possess any qualification or experience whatsoever. So, to sum it up, income of Mr. D is taken as nil and Mrs. D with her income from other sources and the income of Mr. D, the salary that he received 2,15,000, both put together her income is arrived at 2,25,000. So, who is taxed here? Mrs. D is taxed and not Mr. D. Coming to the fourth provision, income to spouse from assets transferred under section 61(1) clause 4. The section which is exclusively for spouse, both wife and husband, as we have discussed in the previous section. So, what is the situation or the scenario here? Direct or indirect transfer of assets to spouse by SSC for inadequate consideration. So, there is definitely an arrangement between wife and husband, this is very natural, but then the act is very clear because the intentions of the SSC could be to evade tax. So, though he has good intentions, but when the asset is transferred to spouse of the SSC with inadequate consideration, definitely it means this is a concept where the transferor, the spouse who has transferred, the income belongs to him alone, because it is already very clear here that there is inadequate consideration. So, it might look like natural love and affection, but still as per the provisions it cannot be acceptable. Income from or out of such asset is clubbed in the hands of the transferor, that is the spouse. So, as we discussed, it could be the husband or the wife, provided the asset is other than the house property. Exceptions to clubbing. So, no clubbing of income in the following cases: where asset is received as part of divorce agreement, if assets are transferred before marriage itself, no husband and wife relationship exists on the day of accrual of the income, asset is acquired by the spouse out of her pin money. Pin money is, that is, whatever she had saved from the income, the amount that is given by the spouse for expenditure of the household. For example, Mr. Mohan transfers debentures of a company worth 60,000 to his wife Priya out of natural love and affection without adequate consideration. So, he has debentures, but he has transferred he transfers debentures to his wife, that is worth 60,000, but he purchases the debentures. So, the consideration is not received. He acquires the debentures, but it is transferred to his wife without adequate consideration. Now, the interest on such debentures accruing to Priya, that is his wife, will be included in the total income of Mr. Mohan, that is the spouse who has transferred. Now, continuing the same concept with the fifth provision, this is more related to the transfers between family members. Assets transferred to son's wife without adequate consideration. So, definitely with love and affection to the daughter-in-law, the parents-in-law would like to transfer some asset or income. So, without adequate consideration under section 64(1) clause 5. So, section 64(1) clause 5, specified person here is the daughter-in-law, and what is the scenario or the situation? Transfer of assets transferred directly or indirectly to daughter-in-law for inadequate consideration. So, the whole underlying concept or the provision which is talking about inadequate consideration, but the assets are transferred. So, any income from such transferred incomes that are accrued from the transfer of such asset is transferred back to the transferee and is clubbed in the hands of the transferor. For example, Mr. Ramakrishna transferred investments worth 50,000 to his daughter-in-law Manasa without adequate consideration. Now, the interest received on such investments by Manasa, the daughter-in-law, shall be included in the total income of Mr. Ramakrishna. So, this was with love and affection, because there was no adequate consideration here, the income or the interest that is so received on the investments will be included in the total income of the transferor. Now, to continue, assets transferred to association of persons. So, association of person, as was discussed earlier, is a trust or a cooperative society. So, with a kind of a feeling to benefit the cooperative society, a person might transfer some assets which might accrue income over a period of time for the benefit of the society or for the trust. The transferor could have done that, but then there are few provisions which have to be applied under section 64(1) clause 7. So, section 64(1) clause 7. Now, who is the specified person here? It could be any person or an AOP, association of person. What is the situation or the scenario? Transferring any assets directly or indirectly for an inadequate consideration to any person or association of persons to benefit spouse either immediately or on a deferred basis. So, the intention here was malified, that is, you are transferring with an intention to support the family member. Income to be clubbed. Income from such assets shall be considered as income and clubbed in the income hands of the transferor. Income to a person, this is the seventh provision. Income to a person from assets transferred under section 64(1) clause 8. So, here the scenario is similar. Any person or association of person is a specified person. Situation here, transferring any assets directly or indirectly for inadequate consideration to any person or association of persons to benefit of daughter-in-law either directly or indirectly, or immediately, or for a deferred basis. Even in such a case, income from such assets will be considered as income and clubbed in the hands of the transferor. For example, Mohan transferred his house to his friend Shyam, directing him to pay the rental income on the house to be given to Mohan's daughter-in-law. Okay. In such a case, though he has transferred it to his friend and he has intentions to benefit his daughter-in-law, now such rental income shall be included in the total income of Mohan. Now, let us look at the eighth provision, income of minor child under section 64(1)(a). So, who is a minor? Who has not attained the age of majority and who lives under the protection of the parents. So, under section 64(1)(a). So, who is the specified person here? The minor child. What is the situation or the scenario or the underlying case? Any income arising or accruing to a minor child, where child includes both stepchild the clubbing provisions apply even to the minor married child or the married daughter. Okay. So, here the whole situation is talking about the income accrued to the minor child. So, even if the child is married, the income, if it belongs to the minor child, it will be added to the income of the parent whose income is the highest. So, income to be clubbed. So, the provision elaborates that income will be clubbed in the hands of the parent who is having the highest earnings. If the marriage of the child's parent does not subsist, that is, both the parents are not living together or they are separated or they do not continue the relationship, income shall be clubbed in the income of that parent who maintains the minor child in the previous year. So, we are talking about the income of the previous year all through. So, the income will be clubbed to that parent who is taking care of the child in the previous year. The minor child's income, though it is clubbed, the SSC can claim exemption up to 1500. So, that is, whichever parent is getting the clubbing affected, he can claim 1500 deduction or exemption. Exemptions to clubbing: income of a disabled child. So, disability is again specified under section 80U, which talks about the percentage of disability of the child or any disability of any person. Income earned by a manual work done by a child or by activity involving application of his skill, that is, you have child artists or we have children who earn for themselves. So, it is because of their specified skill. In such a case, this income would not be added to the child, to the parent. In fact, it will be included as they will be taxed separately. This would also include income earned from investments made out of money gifted to the adult child. Also, money gifted to an adult child is exempt from tax under gifts to relatives. So, this is where the minor child is under the protection of the parent. He has got any inherited property and income is earned on that inherited property. So, the parent who is taking care of the minor child, in case the parents are separated, the parents whose income is the highest, in case they are living together, the parents whose income is highest, the income will be added to that parent. So, clubbing provision is to that extent. Transfer of individual's property to HUF. So, Hindu undivided family, as we all know, India has got families where the grandparents, the parents and the children live together. So, it's a culture. So, it is exclusively termed as Hindu undivided family under section 64(2). So, it is a very common practice that people do transfer their properties or income for a benefit of the Hindu undivided family. So, section 64(2), Hindu undivided family, in case a member of a HUF transfers his individual property to HUF for inadequate consideration. So, the whole underlying provision talks about inadequate consideration. So, that means there was intentions, there was some kind of a conferment that to evade tax, we cannot call it tax planning, to evade tax they have transferred the income or the property. So, in such a situation, income from such converted property shall be clubbed in the hands of the individual. So, few illustrations. Illustration 1, Mr. P owns a shop which fetches a rent of 12,000 per month. He transfers the rent to his friend Mr. Q, but retains the ownership of the shop. So, just to evade tax, it is a clear intention, just to evade tax, he has transferred the rent. He must be having other incomes. So, he pretty well understands that the income that is received on rent, he might be an employee receiving salary income. So, he is assuming that in case the rental income is added to his salary income, he might be taxed at a higher rate. So, just to evade tax, the whole intention is to evade tax, he must have transferred the income to his friend, but the ownership lies with him. So, it is a clear understanding that this is clubbing up of, the provisions of clubbing up of income are applied. Hence, the income received by his friend, though the income is received by his friend, since the property lies in the hands of the transferor, the income gets clubbed to the Mr. P who owns the shop. Now, coming to illustration 2, Mr. J is a beneficiary holding 21% equity shares of PTK Private Limited. Mrs. J is employed as a finance manager in the same company. The monthly salary received by her is 40,000. Mrs. J is not having any qualification, similar to the illustration above. So, here the provision that we need to look into is who is having the substantial interest in the company, what is the percentage of stakeholding, and the spouse of that person, if she or he is employed in the same company without any specialized skills, but earns income. In such a situation, the income so earned by such spouse will be added to the income of the person who has got substantial interest in the company. Okay. So, to conclude, in the above case, Mrs. J had the qualification and knowledge for the finance manager post in the PTK Private Limited, then in such a situation, then income earned by Mrs. J will not be clubbed in the hands of Mr. J. So, we took two scenarios here. One is where he has no qualification, where she has no qualification. In the second case, if she has a qualification, then if she has got a qualification, the substantial interest provision does not apply. Mrs. J will have to pay tax on the income earned by her. In the case of she not holding any qualification, but the income so arrived is all because of the substantial interest of the spouse, then the income will be clubbed to that person's income who has got substantial interest. Now, the illustration 3, Mr. Lucky holds gifts worth 6 lakhs to his, or he is gifted to his wife 6 lakhs. Mrs. Lucky has then invested the same amount in fixed deposit. So, he has first gifted it to his wife. Mrs. Lucky receives the interest of 5,000 per annum from such fixed deposits. As Mr. Lucky has transferred cash, that is, cash is also treated as a current asset without adequate consideration, and it was converted into another asset by Mrs. Lucky. Hence, the interest earned of rupees 5,000 from the converted asset, that is a fixed deposit. So, she converted the current asset to a fixed asset. So, she has changed the gift of liquid cash to a fixed asset. Then what will happen? So, from the converted asset, whatever income that is accrued will be clubbed to the income of Mr. Lucky as per section 64(1)(4) of the Income Tax Act. So, though she has changed the original form of the asset, even then it will be treated as income of the transferor. Now, a few more illustrations before we recap. Say illustration 4, if a bond is transferred for rupees 5 lakhs to the spouse of or daughter-in-law without adequate consideration, an interest of 20,000 on such bond is clubbed in the hands of the transferor. However, if the spouse or daughter-in-law further earns any income from such interest of rupees 20,000, no clubbing provision shall apply on such income. Now, coming to another illustration, if Mr. K gifts a sum of 8,000 to Mrs. N and Mr. N gifts a sum of 15,000 to Mrs. K, say both the gifts are without any consideration, then overlapping amount of 8,000 will be clubbed in the hands of the transferor. So, in all the above cases, one commonality is observed, that the whole purpose of transfer from the transferor to the transferee is to evade tax, though he can term it as tax planning. Evasion of tax is very obvious when people have several incomes, that is income from salary, income from property and other incomes, or has got income from capital gains. So, there is a possibility that he crosses the threshold of 20% and 30% just to evade tax and be in the highest bracket of taxation. He would transfer the income or the asset with an intentions to lessen his tax burden. In such a scenario, the income will be reverted back to the transferor and he shall be taxed.